Now let's take a look how portfolio lab functions are used to solve mean variance and critical line algorithms type of problems. So in portfolio lab, we have a dedicated class which is called mean variance optimization. And here we can see that it has parameters such as calculate expected returns and risk-free rate. So here, as we have discussed, calculating the expected returns is quite non-trivial task. And if you say that the calculate expected returns is mean, the algorithm will just find the historical mean of percent changes of the security to calculate the expected returns. Risk-free rate corresponds to the risk-free rate which is used in Sharpe ratio type of problems to estimate the return of a asset which doesn't have a risk. Basically, that's why it's called risk-free rate, but it's only used when you calculate the Sharpe ratio. So as we can see here, the class implements some classic mean variance optimization, and currently solutions to the following portfolios can be generated. So these are all the solutions we have previously discussed in our lecture series, such as inverse variance, maximum Sharpe, minimum volatility, efficient risk, maximum return minus minimum volatility, efficient return, maximum diversification, maximum decorrelation, or custom objective function. So how do we apply this function? We have a separate function call, which is called allocate. So what are the parameters of this function? So here we need to pass the asset names, this list of strings containing the asset names. Of course, we need to pass asset prices, which then will be converted into percent changes and used to estimate covariances and expected returns. You can also specify your own expected asset returns. As we have previously discussed, for example, you can have your own model which generates expected asset returns, or it can be some financial analyst prediction, etc. Actually, the user can specify the covariance matrix to be used in allocate method. And this is very important because in the future, we will also discuss how to estimate different correlation matrices by not using Pearson correlation, but rather different dependence matrix. And that's why you can specify your own covariance matrix. What you can also do is that we will also discuss how to modify covariance matrix to solve various faults in covariance matrix estimation. And here you can specify your own covariance matrix, which is modified. The main parameter in this function call is, of course, solution. So you can choose various solution strings such as inverse variance, min volatility, max Sharpe. So these are all solution strings which specify what kind of problem you'd like to solve. So if, for example, you would like to maximize the Sharpe of your portfolio, in this case, the solution string value equals to max Sharpe. If you want to find the inverse variance portfolio, in this case, your solution string equals to inverse variance. If you would like to solve type of problem which have investors target return as optimization constraint, you can specify target return of the portfolio. The same applies for target risk parameter. If we talk about quadratic risk utility optimization, which is maximum return minus minimum volatility, in this case, you should specify the risk aversion of your investor. The default value for risk aversion is 10, but you can modify that based on your needs. And the final parameter of the function called is weight bounds. Sometimes, as we have discussed, you would like to apply your own weight bounds in your portfolio type of in your portfolio optimization, and here you can type in the weight bounds. Can be either a single tuple of upper and lower bounds of portfolio weights, so you just specify lower and upper bound, or it can be even some kind of custom weights which are specified in the next way. So this is the mean variance optimization and how it is applied in the Melfin lab. You can use your custom function by calling allocate custom objective function from portfolio lab, or you can use these pre-specified target functions which we have discussed in our lecture. You can specify your own covariance matrix. You can specify your expected asset returns, etc. So now let's take a look at critical line algorithm implementation in Portfolio Lab. So here in Portfolio Lab, we have also various parameters. So as you can see, we have critical line algorithm with weight bounds input. So these are the minimum and maximum weight for all your assets in your portfolio. So meaning that the minimum, so the default value is 0 to 100, meaning that the asset weight can be either zero, the minimum value for each asset weight in your portfolio is 0 and the maximum weight is 1. So if you modify this parameter, you can modify either the minimum values or the maximum values of your weights, of your asset weights. And here we can also see that we still have the allocate method. So it allocates the asset weights using CLA method, and you have also several solutions available. So you can either use CLA turning points, maximum Sharpe, minimum volatility, and efficient frontier. We can also see that we have asset names, asset prices as inputs, the same for mean variance optimization. And we also see here that we have a resample by parameter. So this parameter will be quite often used further in our algorithm. So, and what this parameter does is that if you would like to resample your prices into weekly, daily, or monthly periods to estimate either covariances or expected returns, you can specify the resampling frequency. So D corresponds to daily, big W corresponds to weekly, big M corresponds to monthly. One important note regarding the CLA algorithm is that if you would like to get the whole official frontier calculated by CLA algorithm so that you can play around with that data points and find the value on the efficient frontier, which you think is the best fit for you, you can use CLA turning points solution in your CLA algorithm. And in this case, the algorithm yields not only not the solution, but rather the whole efficient frontier values for you, which can be used in your further analysis. So now we have discussed how Portfolio Lab is used to create optimization solutions in mean variance type of problems and critical line algorithm. And let's jump into the disadvantages of mean variance optimization. So let's take a look at the disadvantages of modern portfolio theory. So in practice, if you play around with the algorithm, we can see that mean variance optimal solutions tend to be concentrated and unstable. So despite the fact that the original design of mean variance portfolio, of mean variance optimization and modern portfolio theory is aimed to produce diversified portfolios, because by design, the creators of this theory say that the diversification is one of the best ways to mitigate risk. In practice, these portfolios are quite concentrated, and as a result, they are unstable. So big portfolio concentration means that some of the assets have quite big weights and some of the assets have relatively small weights, and as a result, the weights are concentrated around 4 or 5 assets among the universe of 20, which actually makes the portfolio concentrated. The second disadvantage is that actually Pearson correlation by its design measures linear dependence between assets, while in modern markets, dependence between assets is usually nonlinear. So we need to understand what kind of matrix can measure the nonlinear dependence, and further in our lecture, we'll discuss those metrics, but the original design of modern portfolio theory assumes that we calculate correlation, linear Pearson correlation matrix. The third and one of the biggest disadvantages of MPT is that in high dimensions, inverting covariance matrix yields unstable and noisy solutions. It is also called Markovitz curse. So what does it mean? So imagine you have a universe of 500 assets in your portfolio. And for example, you use only 22 or 100 points to estimate the covariances. So in this case, you use only 100 points to estimate the covariance between 500 assets. And that's actually the typical situation which faces every portfolio manager. And that is why usually covariance matrices are becoming quite noisy and unstable. If you take a look at the analytical solutions in mean variance type of problems, meaning that the analytical solution is a formula which yields you the immediate result for the optimization. In that formula, the inverse, so the inverted covariance matrix is present. And why it is so important? Because if your covariance matrix is noisy and the information there is not that big, by inverting that, it generates quite unstable and concentrated solutions. So actually, all the problems of modern portfolio theory actually are connected with a Markovitz curse, because we use a few data points to measure the information of dependence between many data points. So in high dimensions, like 500 assets or 1,000 assets. And after that, our covariance matrices become noisy, which yields to concentrated, unstable solutions. Sometimes our portfolio optimizers cannot handle that, and it creates lots of problems. So Markovitz curse is the key part of disadvantages of modern portfolio theory. And the final disadvantage is that actually mean variance optimization approach lacks so-called hierarchy. So what does it mean? So imagine that you are a portfolio manager and you need to understand how to allocate $1 billion into equity market. So what are the typical algorithm which you will follow in your allocation? So first of all, you will divide all your assets in your universe available into groups. For example, equities, bonds, and commodities, right? After that, you for each group inside of these commodities, inside asset class group, you will divide them, for example, on country level, like US-based US-based securities, Europe securities, Asia, Pacific, Australia, etc., etc. Inside of each country, you will define the allocation for each country. So, for example, we'll say that out of the investment mandate of 40% for equities, we will split these 40% for equities into 20% to US-based stocks, 10% to Europe-based stocks, 10% to Asia, etc. Inside of this mandate, we will of US stocks, we will divide it into various industries. For example, financial, technology, etc. Inside of each industry group, we will define how to split the capital. So as you can see, the portfolio manager, when constructs a big and diversified portfolio, thinks in terms of hierarchy, and defines the allocation to a big group, and after that spreads that allocation based on the different subgroups inside of each group. So, and in this case, if you think by using this pipeline, your portfolio is not concentrated because you spread the capital continuously based on first, for example, asset class, then after based on country, and after that based on industry. So for example, if you already allocated 5% of your capital into JP Morgan, Goldman Sachs, and Morgan Stanley, you already have an allocation to financial industry in US stock market. And if, for example, your algorithm tells a portfolio manager that you need to allocate 20% into Bank of America, the portfolio manager will definitely ban this advice because it massively increases the risk of financial industry on our portfolio. So we accept too many risks of financial industries because all these companies will work in one industry. Because in this case, we will have 25% of our portfolio allocated into financial industry of a US stock market. So we would rather like to add no more than 2 or 3% of Bank of America because they are in the same industry as Goldman Sachs, JP Morgan, and Morgan Stanley. That's what actually modern portfolio theory does not do. So the correlation matrix is a great way to measure the dependence, but we also need to introduce some kind of hierarchy. So how assets are grouped inside of each industry, define the weight allocation to the group of assets, and after that spread that weight on the individual asset level. So this is actually how the most of discretionary portfolio managers think, and we need to somehow modify the approach of modern portfolio theory into this framework. That's actually what HRP, HERC, and NCO algorithms do, but we'll discuss them later. But first, we need to understand how to solve the problem of noisy covariance matrices by applying denoising, detoning, and shrinkage techniques. So let's take a look at them. So the first and the quite well-known shrinkage technique is so-called a Denoising shrinkage. So essentially, the basic shrinkage method makes use of the following convex transformation. So basically, shrinkage is just the transformation of our covariance matrix so that we still preserve the information but reduce the amount of noise which is present in a covariance matrix. So on this slide, you can see the basic shrinkage method, and Lenoir-Wolf suggested shrinkage method to address the problem of noisy covariance estimations. The estimator linearly shrinks the sample eigenvalues to the ground mean while retaining the sample eigenvectors. So in Lenoir-Wolf shrinkage, method differs from basic shrinkage as it aims to compute optimal alpha value that minimizes the mean squared error between the estimated and the real covariance matrix. So what actually is shrinkage about? Shrinkage is just a way to modify our covariance matrix by still preserving the correlation and dependence structure, but by decreasing the noise inside of the covariance. And after that, our solution become more stable. It is easily to invert those kind of matrices, etc. Let's take a look at the other ways to shrink the covariance matrix. The second way of shrinkage is so-called constant residual eigenvalue denoising. So denoising is also the way to shrink our covariance matrix by modifying it and still preserving the information. So shrinkage is done by determining the maximum theoretical value of the eigenvalue of such matrix at the threshold and then setting all the calculated eigenvalues, the threshold to the same value. So actually this method was introduced by Marcos Lopez de Prado in his paper, A Robust Estimator to the Efficient Frontier. And let's briefly go through the algorithm and discuss. So on the first step, the eigenvalues and eigenvectors of the correlation matrix are calculated. We use kernel density estimate algorithm on a kernel of eigenvalues to estimate that. So basically, kernel density estimate just approximates the empirical values by some numerical probability density function, which can be used in the future to generate quantiles, mean values, probabilities, etc. So we fit kernel density algorithm on our eigenvalues, which were calculated from a correlation matrix. After that, we use the Martenko-Pastur PDF is fitted to the kernel density estimate using the variance as a parameter for the optimization. So in Marcos Lopez de Prado original paper has shown that using that Martenko-Pastur PDF is a great way to estimate the is to apply probability density function on top of eigenvalues from covariance matrix. So this type of distribution works extremely well in this type of problems. So from this obtained distribution, the maximum theoretical eigenvalue is calculated using the formula from the paper. So what we do here, we want to understand, so what is the maximum amount of information which is available for us when we fit Marchenko-Pastur probability density function on top of that, meaning that all eigenvalues with values more than this maximum average value will be denoted as noise eigenvalues. So on the fifth step, the eigenvalues in the set that are above a theoretical value are set to the average value. So all these big eigenvalues, which are much bigger compared to the average value, will be decreased by their average value. And this is the way how we reduce the amount of noise in our covariance matrix, by averaging all those values which are outliers compared to the maximum theoretical value, which is defined by Marchenko-Pastur probability density function. So the new set of eigenvalues with a set of eigenvectors is used to obtain the new denoise correlation matrix, which is transformed into covariance matrix. There is a very quite well-known formula for transforming correlation matrix into covariance matrix and vice versa. Now, let's take a look at the final way of transforming the covariance matrix to get more information from that, which is called detoning. So if you are familiar with PCA methods, which are quite widespread in finance, we all know that the first principal component of PCA usually refers to a so-called market component. So, and the same applies for financial correlations. So financial correlation matrices usually incorporate a market component. So the market component is characterized by the first eigenvector. So what does it mean? What does it mean that correlation matrix usually incorporate market component? So if, for example, the S&P 500 index increases in 5%, right? It has 500 stocks on top of that. And if people start buying the S&P 500 ETF, the hedge fund, so the ETF provider, also needs to buy constituents of S&P 500 to match this demand. And in this case, some of the stocks starts to rise because we see the pressure, the buying pressure from the ETF provider. As a result, the price of a security rises not because some positive news came to the market, but rather because the whole market is increasing in its price, and as a result, the constituents of this index also increase in its price because ETF providers start buying the stocks. This is the first way to show how market component is included into the correlation matrix. The second way is that when our markets move upwards, sometimes all the constituents of index just move upwards just because there is a whole positive sentiment regarding the US stock market, and everyone buys lots of stocks, and as a result, market component is incorporated in the dynamic of asset prices. So accordingly, a market component affects every item on of the covariance matrix. In the context of clustering applications, it is useful to remove the market component if it exists. This hypothesis can be actually tested statistically. So by removing the market component, because this market component applies to the whole covariance matrix, right, and we can remove it, we allow a greater portion of the correlation to be explained by components that affect specific subsets of the securities. So what does it mean? When we want to cluster our assets, we don't need the market component included into the covariance matrix because there is no need in that. Because we all know that the market, of course, had a big impact on all our asset prices, and we just need, we can just take away this information because we don't need it, and it is redundant to our clustering and may reduce the clustering efficiency. So that's why we need to somehow extract this first eigenvector and this market component out of a covariance matrix to get a better understanding of how specific subsets of securities are clustered. And that's actually called detoning. So it is similar to removing a loud tone that prevents us from hearing other sounds. Detoning is a principal component analysis analog to computed beta adjusted or market adjusted returns in regression analysis. So if you are familiar with capital asset pricing model, beta coefficient, you do know that some of the financial analysts really like to compute market adjusted and beta adjusted returns by subtracting. So this is a way to subtract the market component dynamics out of the security. And detoning is another way to do that. So we have discussed how to use, what are the ways to solve the Markowitz curves in terms of covariance matrix. We have discussed how to apply Lenoir-Wolf shrinkage, how we can apply the shrinkage method, which is described in robust estimator of efficient frontier from Marcos Lopez de Prado paper. We have also discussed how to remove market component from a covariance matrix by using the detoning technique. And in the next lecture series, we will take a look at portfolio lab functions which do that for us, and also discuss what are the other dependent matrix except for linear Pearson correlation, which can measure the dependence between two assets.